smart beta and factor investing. That's our topic. What is smart beta? Well, a really simple answer is it's a combination of alpha and beta. So a combination of active strategy and passive strategy. What does that actually mean? Let's boil it down a bit further. You've got, on the alpha side, alpha chasers who are fund managers. They're trying to find that market inefficiency. They're promising you it. They allow more risk. And they're quite expensive. On the other side, you've got this more automated approach with beta. It's a computerized model. It follows a selected set of index stocks. And your stock selections move alongside the market. So overall, in the long run, you'll benefit as the market improves. You'll get a modest return, but you'll definitely get a return. So the thing about that is it's definitely less risk, and it's cheap, excellent, but it's pretty dumb in the sense that it focuses and overweighs large cap stocks, large companies, and undervalues the critical small cap opportunities that someone like an alpha investor, fund manager would highlight. So why don't we combine the two and find some kind of happy medium here? And that's what smart beta is. It's the best of both worlds. It mixes passive and active at some ratio. And it's really about optimizing those beta factors. Of course, there's many skeptics, however, and a really great benefit is obviously its moderate cost. So Juliana now will talk a little more in depth regarding smart beta.
So smart beta is a rule-based portfolio construction process. The idea is it's a set of investment strategies that emphasize the use of alternative index construction rules rather to the traditional index that we already know. The smart beta experts say that the market is not always efficient. So sometimes the prices, show accurately what is going on in the market. So the idea is to find new factors to analyze and to make better decisions about the stocks where you want to invest and how much to invest. So the idea is to seek and exploit market inefficiencies by anchoring on factors other than price. That's the idea, to look for factors different than price. So some of the benefits that smart beta experts say that this thing have, for example, improve portfolio outcomes, reduce portfolio cost because it's in the middle of active and passive management, increase transparency because the rules are always predetermined. You can change the rules or the factors in the middle of something. At the beginning, you know the factors that you are going to use. And it has objective rules and captures well understood the drivers of return. Some of the factors, maybe the simple ones are those. For example, value and quality are very interesting. For example, quality focus on factors such as equity return, leverage ratio, and earnings probability. And this factor is one of the innovations of smart beta because, as you see, introduce maybe some things related with the quality of the balance sheets of the company. This is something different than the traditional index. And also the value for this connection between a company's stock price and its intrinsic value, something that we try to do in our class. So this is one of the factors that you can use. To understand better what smart beta is, it's important to go to the roots of smart beta. It's actually the factor investment. It's a concept, an old concept up to 1960. And the idea of the concept is to define the factors that drives a better return. To explain you in a better way, we just have here an example. Nutrients are for food, while the factors are for the assets. So if you are a healthy person, you want to choose the nutrients that are better for you and for your health. So you analyze not only the kind of food, for example, a fish, you analyze also the kind of nutrients that a fish can give you to your health. It's the same thing for factors, and the idea is that factors are fundamentally the building blocks of the investment returns, and you can measure the factors that you want to use. So Devon will tell you about some of the strategies about smart beta.
So investors are able to choose which factors they want to invest in. One of the ways that they might choose between certain factors is to look at the risk and return of factors. So MSCI is an equity, fixed income, and hedge fund stock market index provider, and these are some of the factor indexes that they provide. So as you would expect, the minimum volatility factor delivers the lowest annualized risk. We can also see that the momentum factor delivers the highest risk, but also the highest return. So another characteristic that investors might look for is past performance of factors. So although factor returns are highly cyclical, there typically have been trends in how they perform in the past. So typically value, momentum, and size factors have outperformed in strong macroeconomic environments, while high dividend, quality, and minimum volatility factors have outperformed in weak macroeconomic environments. So one specific strategy that I came across when I was researching this is a strategy dubbed betting against beta. So according to the CAPM, risk and return are related to beta, and supposedly the higher beta you have, the higher return you will have. Although we've learned that there's weak empirical evidence to support this theory, and in fact, high beta portfolios do not perform any better than low beta portfolios, as we can see from Mike's slide. The relationship between beta and return is actually relatively flat. So this is one of the inefficiencies of the CAPM. So AQR is a hedge fund, a large hedge fund that employs the betting against beta strategy, and they seek to take advantage of other inefficiencies with the CAPM model. So their basic strategy one of the basic strategies is to short sell stocks with a high beta and to buy stocks or take a long position in stocks with a low beta. So their reasoning is that because institutional investors and because individuals are constrained in the amount of leverage they can take, which means they have to resort to other means to get high levels of return on their investments, what there's a tendency to do is they'll invest in high beta stocks in order to increase their potential return, and this leads to an overweight in high beta stocks. So to take advantage of this, or what this means for AQR, if they're correct, is that high beta assets will be overpriced and low beta assets will be underpriced, and so that's why they short sell the high betas and buy stocks with the low beta. So Lee will talk about how other big players use factors to invest in.
So smart beta products have been becoming very popular for investors, and about 89% of the non-users have expressed the interest of using them in the near future, and then 35% of the investors are actually using them in their investment. The smart beta has been most frequently implemented in the ETF, and then the most frequent use is in internal risk control and so smart because technically anybody can use smart beta, but then because of the complexity of calculating it, the investors who have been using smart beta in their investments are mostly from the top investment firms such as BlackRock, the Vanguard, and the company that we just mentioned earlier. And then the rest of the investors, they either choose to consider or value the smart beta but not necessarily use it, or the other just show a strong interest in wanting to learn and educate before they actually use it. And then according to a survey that was done by FTS Russell, about 42% of the investors actually don't use smart beta because they don't feel that they know enough about it. And then the next 35% of people actually think that they don't use it because there's not enough historical data or any record for them to analyze. And then Uday will talk about the growth in smart beta strategies.
So to analyze the growth in smart beta strategies, we looked at the amount of investments that are coming into smart beta assets. So just some quick facts. the number of smart beta global providers, it grew from 54 in 2012 to 92 in 2015. So that's approximately a 70% rise in global providers. Also, 1/12 of all the investments coming into assets has been into smart beta strategies. So it's just representative of the demand that's coming in. But let's see how that goes. So this is a breakdown of all the smart beta assets based on the different type of factors. So as we can see, the minimum volatility factor that has had the highest annual asset growth, 21%, whereas for all the other type of factors, it has an average of 40%. That's basically representative of the volatility in the market. The markets are generally more volatile, and then people are expecting to invest in something that is more safe, hence less volatile, that is more predictable. So a deep dive into this based on the countries. We did an analysis of US versus Canada. So if we look at the minimum volatility factor, then Canada made a lot of investment into minimum volatility smart beta portfolios as compared to US. So that's again representative of the risk averse nature of the Canadian investments. But the question that we need to ask is smart beta really smart? Should a smart investor be investing into smart beta portfolios? So we did a small analysis based on an S&P 500 low volatility portfolio, and we compared it against S&P 500. So these two regions, I mean, if you look at it overall, it appears to be moving in the same way. But these are the two regions where it sort of differed. The second reason here is basically so the lower line is S&P 500, the upper line is the portfolio that we chose. So you can see in the second region, when S&P 500 dipped, that is the point when this minimum volatility portfolio, it stayed constant or slightly increased. So that is where you gain. But the flip side is the first part. When S&P 500 grew at a larger rate, then to this minimum volatility portfolio, it stayed constant, right? So it's like you gaining at one point and then losing at the other. So this is what we think about it. The S&P 500, it's an average of all the factors, and we are trying to focus on just one factor, and we'll regress to mean in the long run. So how smart is it? So these are certain concerns that we came up with. It might represent a false alpha, crowding because it's a new thing that has come up, so it might have the newbie advantage. Then you can have certain issues like tracking error and trading issues.
So where does that leave us? What do we do with this now? Basically, the alpha fund manager will come to you and pitch the idea that I alone will beat the market, I'll find the market inefficiencies. But in the real world, 2008 and other instances, it doesn't quite work out for that fund manager. And so the investors then shift their energies and idea of their money over to the passive strategies because they're cheaper and they basically get similar outcomes in that case. So enthusiasm shifts over to the passive beta side. But they, as the fund manager, of course, they're in the business of making money, so they want you to come back. Why, we didn't beat the market, but still want to help you out. Why not try something called smart beta? And we'll have some data, as we showed as well. The Guggenheim 2003 smart beta portfolio strategy, it produced 11.5% per year, whereas the cap-weighted got 8.4%. So clearly, he would say, or she, this is a great opportunity for you. You should get into smart beta. And even on the academic level, Cass Business School says that this can work. They did a study. They got 10,000 monkeys. No, they got 10,000 portfolio stock sets, and basically took that, randomly selecting them, and applied a smart beta formula to that set of stocks, or those separate incidences, those separate fund managers, as it were. And the outcome was that it did outperform the cap-weighted average. So it clearly works. So in conclusion, there is a lot of debate, and I don't think it works, in my opinion. We've got a little bit of a debate on it, but in essence, there's a lot of people who have an opinion about this. The President-elect of the United States actually tweeted about this. So a couple nights ago, in fact, at about 4 a.m., Donald Trump tweeted this. Smart beta is for dummies, big league. Like that totally failed former host of The View, Rosie O'Donnell, failed investor, sad, hashtag dumb beta. And Rosie O'Donnell, she was up at 4 in the morning as well, and she followed up with this response. Wow, actual president-elect is at it again, this time criticizing my investment strategy. Smart beta works for me. I hate fund managers almost as much as talking pumpkins. Yeah, real Donald Trump. So there's a lot of debate, there's a lot of anger on this issue, and we'll leave it for questions.
So, if I understood this correctly, it seems that smart beta investors are supposed to actively pick the trends and create a portfolio based on those underlying trends, right? That's in the beginning.
Yeah, you look at the factors to inform your
The
investment.
second part that was mentioned somewhere later was that you are required to actively readjust your portfolio based on the ongoing trends or the changes in these trends. Did I
So,
understand that correctly?
I believe the way I understand it is there's different ways to implement the strategy. One way, what you have to do is when you purchase these factors, they're going to change over time. So I think there will be readjustments that are necessary.
So my